In response, the directors have decided to invest in a market development strategy for future growth, utilizing significant cash reserves to acquire companies in other areas of the country where competition is less intense. The board has identified a potential target, Denton Company. Now, this Denton Company is the target, the Kerrin Company is the acquirer. And now you are going to acquire a company in the less intense competition areas, in other areas of the country. Now, this is the Denton Company data that the examiner has given to you. Denton Company is a privately owned consumer electronics company established 10 years ago. Significant unrelieved losses were incurred in the early years of the development, although the company is now profitable and achieving growth in earnings before tax of 6% per year. However, cash reserves are low. This company is having the cash reserve. This company is having the low cash reserves, but access to capital has acted as a severe constraint on Dentro Company reinvestment potential throughout this period. The founders and their families own 60% of the shares, with the balance held by the venture capitalist organization, which acquired a security stake around 6 years ago. Now, what is happening? This Denton Company, as this is a private business, private owner, so the 60% stake is with the owners, and the 40% there is some venture capitalist organization who has done the financing for the company, and the 40% stake they are having in the company. So you are going to acquire a private company in which you have to look for the concerns of the venture capitalist as well. Acquisition information. Kerrin Company board is keen to ensure that Denton Company founders remain as directors after the acquisition, and the company has sufficient cash reserves to purchase the Denton Company outright. Early discussions between directors of both companies suggest Denton Company shareholders would approve a cash offer of 13.0 per share. An alternative, the board is considering a share for share exchange to fund the acquisition in order to preserve cash for the future acquisitions and dividend payments. Recent mergers have attracted an acquisition premium of 25 to 30%, and Denton Company directors indicated their shareholders would be accepting a premium towards the higher end of this scale for a share for share offer. Means they will be accepting 30% premium. Kerrin Company has therefore asked you to design a share for share scheme which will allow for a 30% acquisition premium. You have been provided with the text from the latest financial statement for both of the companies. The operating profit mean, the PBIT has been given to you. Now, this is the additional financial information. The book value of the Kerrin Company, mean the acquirer, this is the 0.50 ordinary shares is 375 million. These shares currently trading at this, and the finance director expects that the price earning ratio to increase by 10% if the acquisition proceeds. Mean, if you are going to acquire the company, then whatever your current price to earning ratio is, that will be increased by 10%. Now, Denton Company upgraded its manufacturing facility during the previous year and expected to make annual pre-tax cost saving 2.5 million from the start of the current financial year. The book value of the Dentron, this is their 0.25. This is the face value, is 35 million. Based on the analysis of companies of a comparable size and structure, it is estimated that the Dentro company price earning ratio is 20% higher than the Karen company price earning ratio. It's mean if you want to calculate the Karen company price earning ratio, so sorry, the Dentron company price earning ratio, first you have to calculate the Karen company price earning ratio and then you will increase it by 20%. Karen company chief executive estimates annual pre-tax revenue and cost synergies 15.2 million to arise as a result of the acquisition. In addition, the finance sector has anticipated annual pre-tax financial synergies of 5.3 million, although she insists this is a cautious estimate after reading an article on recent merger and acquisition where post-acquisition synergies have either been overestimated or failed to materialize. The rate of the corporation tax is 20%. Examiner is asking you the first paragraph. Discuss the possible sources of the financial synergy arising from the Karen company acquisition of Dento company and comment on the finance director concern that synergies are often overestimated, including any steps which could be taken by Karen company's board to address this problem. So guys, this is a purely theoretical area. The B part, advise the directors on a suitable share for share offer which meets the criteria specified by the Dentro company shareholder and calculate the effect of the cash and share for share offer on the post acquisition wealth of both Karen company and the Denton company shareholder. So this is the means the numerical area and discuss the reactions of the Karen company and Denton company shareholder to cash and share for share offer. So the question was not quite, you can say, the complex. The question is quite easy. Those students who already have a knowledge of my methods of financing merger, in which I have discussed the cash offer, the share for share offer, the bond offer, they already know that how to solve this question. Ms. Sohaila, have you gone through that? The methods of financing merger?
Not yet, sir.
Okay, no problem. Georgina. Georgina, do you hear me?
Sir.
Georgina, let me know.
Yes, I can hear you now.
In this question, examiner has given you the annual pre-tax, mean annual synergies have been given to you. So how you can compute the combined market value? Can you tell me? Anyone in the class who will tell me if you have been given the annual, so how you will be computing the combined market value? Tell me, guys.
Sir. Sir.
Yes.
For the combined market value.
Yes.
Are you hearing me? Can you hear me?
Yes, yes, I can.
Market value of the target plus the total synergy.
What are you saying?
I said for when we are giving the total synergy, that's for the combined market value, we'll take the market value of the acquirer plus the market value of the target.
But in this question, in this question, you have not been given the total synergy. You have been given the annual.
Okay. That's going to be the combined.
So is it the earnings of acquisition of acquirer plus earnings of target plus synergy? I don't know.
See, guys, we covered this in detail. Whenever you have been given the per year synergy, you will be taking the earnings of acquirer, earnings of target plus synergy, and you will be multiplying these earnings with the price to earning ratio of the group or acquirer. We already solved the question on that. Now, for the time being, try to understand. First of all, let's go through the A part of the question. Discuss the possible sources of the financial synergy. Financial synergy means we have to look for the finances and comment of the finance director concerned that these synergies are overestimated, and if these are overestimated, how you can overcome this. Try to understand now, guys. First of all, everyone remember the examiner is always writing up to the maximum. You are not required to write down each and every line, but you have to pick up the maximum points. We are solving the part A of the question. Examiner has asked you the possible sources of the financial synergy. Many acquisitions are justified on the basis that the combined organization will be more profitable or grow at a faster rate than the companies operating independently. The expectation is that the acquisition will generate higher expected cash flows or a lower cost of capital and creating values to shareholders. Please, those points who I am highlighting, these are the main points. The additional value created is known as synergy, the sources of which can be categorized in three types. We already know. One is the revenue, other one is the cost, and other one is the financial synergy. So basically, first of all, examiner provided the definition of the synergy, and then examiner told you that there are the three types of the synergy. Now, in this question, the synergy which is valid for us, that is the financial synergy. Based on the scenario, there are a number of possible sources of the financial synergy. Now, try to understand. You know that the Kerrin company is the acquirer and the Dentro company is the target. This Dentro company is a private company, and the Kerrin company, this is a public limited company. This is a listed company. Examiner is saying as private company, Dentro company is experience a funding constraint, whereas Kerrin company has significant cash reserves but limited growth opportunities. You know, I highlighted in the question, one company is having the cash constraint, other company is having the significant cash reserves. So what will happen? The combination of the two can create additional value, since Denton may be able to utilize Kerrin cash reserves to fund its expansion in a way which would not have been possible otherwise, leading to increase in the expected cash flows. So one is this. Number two, assuming both companies' cash flows are less than perfectly correlated, those of the combined company will be less volatile than the individual companies operating independently. The reduction in volatility enables the combined company to borrow more and possibly cheaper finances than would otherwise have been possible. This increase in the debt capacity and therefore the present value of the tax shield increases the value of the combined company in the form of a lower cost of capital. Very interesting point examiner has identified. Like previously, both were having a separate company status. Now when both are combined, they will be known as a group. Now when a bigger company is going to bank for a loan, the bank will be offering better terms and conditions. The debt capacity will be increased, or if better terms and conditions are being granted to them, so what will happen? The interest cost will be lower. The interest cost will be lower, and if the interest cost is lower, automatically it will be lowering the cost of capital as well. Now further benefit, there was, see guys, in this question, why examiner has given you such data? The examiner told you that the Kerrin company, the Denton company has significant unrelieved losses. Now what is happening, guys? These losses can be carried forward when the group is there. See now, further benefits may arise if the Kerrin company is able to utilize Denton company unrelieved tax losses. While Denton company is no longer loss making and could offset these tax losses independently, the combined company may be able to obtain tax relief earlier, since the acquisition increased the availability of profits against which the carry forward losses can be offset. The present value of the tax shield will be therefore be greater in the combined company. You know what is happening on the losses? If you offset them on the losses, we claim tax, and otherwise if you are carry forward them, so your tax payable will be lower. So examiner is trying to explain to people, when both companies will be combined, what will happen? The combined company is having the more cash flows, the more profits will be there, and against that profit, these losses can be offset. Now, if both companies were publicly traded, there would be no benefit from diversification, since investors are capable of diversifying at a lower cost and with a greater ease than the company. However, Denton company is privately owned and the shareholders are therefore exposed to the unsystematic risk. Therefore, the acquisition may lead to potential diversification and risk reduction benefits. The reduction in the cost of capital increase the value of the combined company. Now, see guys, this is a very important point that the examiner has identified. You know that those students who are with me since the start, what is the point that the examiner has discussed here? We are solving Kerrin company. See guys, what is the point? The point is, you know that we have studied the CAPM, capital asset pricing model, and in capital asset pricing model we said that the unsystematic risk can be reduced by holding it well diversified portfolio. And this is in the case of if the companies are public companies, public listed companies. Now the point is, the company which you are going to acquire, the Denton company, the Denton company is a private limited company. The Denton company is a private company. So the Denton company shareholders, they are facing this unsystematic risk because they are not well diversified. They are private limited company. So if now they are going to combine with another company, so this is a way of reduction their risk. Otherwise, if this company has been also a public limited company, so the risk diversification is already there. There was no need to do that. Okay. So this was basically the points that what are the sources of the financial synergy. See, That's why I already emphasized that the data which has been given to you in the question, that data is not, mean to say, it is not a wasted data. It has something to ensure that it is being used in the question. Now the examiner was saying overestimating of synergy value, there was a concern in the question. There is evidence that the bidding companies overestimate the value of the synergy arising from the potential acquisition, with the result that the companies pay too much for their target. Like when I am a acquirer and I have performed the calculation, and from my calculation it is being seen that the combined company is beneficial because the synergy benefits, the additional benefit is there. So now I will try my level best to acquire that company, and I will be paying the excessive premium on the market value of that company. Now what will happen when this happens? There is a destruction in the wealth for the bidding company shareholder. There are a number of possible explanations for this problem. First, merger and acquisition actively tends to be driven by the availability of cheap credit. At the peak of a wave activity, there may be competition for targets, thereby increasing acquisition premium. First of all, what is the reason? What is the overestimating? Like, it is not only the me which is interested to acquire the Denton company. There may be possible 2 or 3 buyers are there. So what is mean there? When there is a peak of activity, everyone wants to buy the company. So there may be competition, and that's why we have paid the increased premium. And that increased premium is the reason for overestimating the synergy. Second, the conflict of interest may be lead to a biased valuation process. Deal advisors, such as investment banks, earn a large proportion of their fee from merger and acquisition. Their advice on whether an acquisition makes sense is potentially biased if they do not look after their client's interest. Like if there's an agent, the agent is charging from me a fee or a commission. They are just concerned for their commission. They are not telling you the fair advice. That is the reason you have gone for a wrong company whose benefits were not actual, whose benefits were not real. Third, management overconfidence. Management overconfidence may explain why this occur. Acquiring companies may overestimate the acquisition synergy or underestimate the time will it to take to deliver. Management may be then reluctant to admit mistakes when the facts change or even there is still time to back out of the deal. Agency cost may also be a factor if managers are more interested in pursuing personal goals than maximizing the shareholder wealth. So basically, these are the things. What is this? Easily understandable. Now, what are the steps to solve the problem? Very easy. The responsibility needs to be allocated to someone who can ensure spare cash is utilized to invest in new growth opportunities. The tax losses are offset as efficiently as possible, and the combined avails itself cheaper financing. Companies which allocate this responsibility and monitor and review performance tend to be more successful in creating a value. In order to avoid any bias, the deal advisors who stands to profit from an acquisition need to be separate from the valuation process. Effective due diligence ensure that the financial documents which form the bias of the valuation are scrutinized and inspected. Now, this is very easily understood. What is happening? Examiner is trying to explain you people that whatever you are doing before relying on the figures, the data the target company has given to you, you should go for the due diligence. The due diligence is a third party in the independent review, and normally this is being done by the auditors. The auditor will be giving you the due diligence report, and in that a conclusion is being made whether you should go for this company or not. And if there is an investment banker or some agent, you should give them their fair price so that they cannot commit the biased decisions. Okay, and when you are paying the premiums just to win the deal, we had studied a terminology named as the winner curse. And winner curse was, what was that? In the winner curse, we are just paying the higher level of premium just to win the deal. We should not do that until unless there is a genuine reason to do so. So these are the steps to address the problem. Now, the second part of the question. Advise the directors on a suitable share for share exchange offer which meets the criteria specified by the Dentro company shareholders and calculate the effect of the cash and share offer on the post-acquisition wealth of both Kerrin company and Dentro company shareholder. So basically, very easy. Just we try to solve it. Okay. Rukayat, do not annotate the screen, please. Okay, now guys, first of all, try to understand one thing. First of all, in this paragraph, examiner is saying to you people, advise the directors on the suitable share for share exchange, which meets the criteria specified by the Denton company shareholders. First of all, try to understand what was the criteria by the Denton company shareholders. The Denton company shareholders, what they have said to you. Denton company shareholders would approve a cash offer. This is an alternative, a share for share offer to fund the acquisition in order to preserve cash for the future acquisitions and dividend payments. Recent mergers have attracted. Now they have said to you, Denton company directors indicated their shareholders would be expecting a share for share offer scheme which allows 30% acquisition premium. So this was the point. Now, first of all, in this question, try to understand the synergy per year has been given to you. If the synergy per year has been given to you, so to get the combined market value, in the first step, we calculate the combined earnings. What we calculate? Now, combined earnings is equal to earnings of acquirer, earnings of target plus synergy. The earnings of acquirer have been given to you in the question as 3.305.5 plus 95.05, and there are two synergies in this question. One is 15.2 and the other one is 5.3. Again, I am telling you people where the data is. See, this was the PBIT, profit before interest and tax. This is the earnings before tax. This was the earning before tax. Just make them after tax. Make them After tax. Let me know. These figures are coming. Is this correct? How this is coming? 318 into 1 minus t. Okay. And there was one more point in this question, and what was that? These synergies figures, which the examiner has given to you, these are also pre-tax. Make them after tax as well. Add up both of these, multiply by 1 minus 0.20. Now let me know what are the total earnings coming. These are already, these two are, I have already after tax them. So is this coming as 416? Tell me guys,
Sir, should that be 381,
which one?
the pre-tax figure?
Oh, it's okay. 381. Okay, now, you know that the combined market value is equal to combined earnings. Multiply by price to earning ratio of group. Now the examiner told you that the group price earning ratio. Examiner told you people in this question that the group price earning ratio increase by 10%. Okay. So it's mean first calculate the price earning ratio of the Kerrin company and then increase it by the 10%. Price earning ratio of Kerrin company. What is the formula of the price earning ratio? Market value over EPS. Tell me, what is the market value of the Kerrin company, guys? It has been given to you in the question. What is the market value? See, this is a point that you people do not participate in the. This is the market value. And these are the earnings. These were earnings were before tax. We have already made them after tax. Don't know that why you don't participate in the lecture. Tell me guys, what are the market value? Are you listening or I am talking to someone else?
So I'm still trying to download the question.
Okay, to get the market value, we've been given the book value of 4.5 ordinary shares of 375. So to get the market value, we would divide 3.75 divided by 0.5. Then we get the numbers of shares multiplied by 5.28. Then we get the market value of the shares for carrying. Now to get the
Joy, you are saying on the total basis calculation?
yes, sir. Yes, sir.
Why we want, or you can calculate on the per share basis as well?
Okay, that's fine. So for the partial basis, for the I'll pick the 5.28 as the market value for the shares. Then for the earnings before tax, I'll divide it by the numbers of shares. That's
Okay,
750.
if you want to calculate on the total basis as well, so what are the total number of shares?
750.
And the market value per share is 5.28.
Yes, yes.
And what are the earnings? We have already calculated that are 30, 5.5. What is the price earning ratio coming? This is coming as 12.96. This is
Yes,
the price
4.96.
earning ratio of the Kerrin company. Now, examiner told you people, if the acquisition proceed, this price earning ratio will increase by 10%. Examiner told you people in the question that if the acquisition proceeds, then the price earning ratio will increase by 10%. So guys, if acquisition proceeds, then 12.96 multiply by 110%. What is the answer coming? 14.25. This is the price earning ratio which is applicable when the acquisition proceeds. Now see guys, the combined earnings are 416. This is 14.25. What is the combined market value coming? What is this? 5.
5930.
This one.
Yes.
This is the combined market value. Now, see, this is nothing. We have already gone through this. If the synergy per year has been given to you, the lecture is available on the portal as well. That how you will compute the market value. Now, what is this total market value coming? 750 multiplied by 3.28. What is this? 39, I think 60. This is the Kerrin company market value. This is the Kerrin company market value. Now, can you tell me guys, anybody in the class who will let me know that if in this question you have to compute the additional benefit, how you can compute that? Tell me. Anyone? Try, tell me. Can you compute here the additional benefit? You have the combined market value.
Yes.
This is the combined market value. This is the market value of the acquirer. And the Tentro market value, can you compute? Yes, we can compute the
Yes.
Tentro market value as well. The examiner has given you that the book value of this is this, and the Tentron company data B. The Tentron company data.
Ṣojú bó wo lẹ́lẹ̀ tó ti rí. Tí bá tọ́wọ́ mi bá ba ẹgbà ẹ̀.
Ruqayyat,
Sorry.
mute your mic.
Ìmọ̀ ẹ̀yìn ẹnu òṣìwò ló ń sílẹ̀.
Okay. Tell me, Joy, how you will compute the market value of the Tentron company? Tell me. Oh my God. See, examiner is giving you the clear hint in this question. Examiner said that the Tentro company price earning ratio, the See, this is, it is estimated that the Dentro company price earning ratio 20% higher than the Kerrin company price earning ratio. So guys, what is the problem? If you want to calculate the market value of the Dentro company, what is the formula? Earnings will be multiplied with the price to earning ratio. Price to earning ratio, we have already computed how much it is coming. 12.96. Examiner told you increase this by 20%. So 12.96 multiplied by 120%. What is this coming? The price earning ratio. How much? 15.55. And what are the earnings of the Dentro company, guys? This is the earnings. 95.05. What is the market value now? Tell me. $1,478. Now, can you compute the additional benefit or the synergy? The combined market value is 5930 minus 1478 minus 3960. Is there any additional benefit? $492. Now try to understand. What was that? This is already we solved 2 or 3 questions on this pattern. One was the question of the Nanti company. One was the question of the Sigra company. One is the question of the Nahara company. Today we are solving this Denton company. I will upload a question on the portal named as the Celorne company as well. Now, how much is this additional benefit? 492. Everybody clear up to this point? Clear, guys? Should we move on?
Yes.
Okay, now. See, if you go through the examiner answer, see what the examiner has done. This Kerrin company value we have find out. This price earning ratio we have find out. What is this? 3960 is the value of this. This is the value of Denton company. This is the synergy 524, which we have also find 490 something, because we have taken the price to earning ratio as how much it was coming? Our price to earning ratio. Yes, 15.55. So the difference, this is 5930, 12.96, 14.25, 48.
Sir,
Okay, see, we have taken the 14.25. The examiner has taken 14.3. So there is nothing a problem. Yes, everybody clear up to the synergy? Tell me, guys.
Yes.
Okay, now Now we have to go for that offers. Who will be solving the offers with me, guys? First, we will be solving the share for share. In the share for share offer, plot here the pre-data. In the pre-data, you are having one is the Kerrin company and the other one is the Denton company. This is number of shares. This is their per share value. This is the total. How many are the number of shares, guys? The Kerrin company number of shares.
750.
750. And the number of shares of the Denton company 140. The Kerrin company per share price, how much it is? Tell me.
Maybe 5.28.
5.28. And the Denton company, we can find out. The Denton company total market value is 1478 divided with the number of shares. The number of shares are 140. How much this is coming? Tell me.
10.55. 10.55.
So this is 10.55. Let me know the totals, please. What is the total? Georgina. 3960.
3960.
And this one.
Yes. 1477.
4.
1477.
Okay, now you can compute the total. Now this is the post data. Try to understand very carefully what was the differentiating point in this question. What was the combined market value? This is the combined market value 5930. Now try to understand one point. Examiner or the shareholders were of the concern that they will be having the share for share offer if they have been granted the 30% premium on their value. So guys, what was the previous value? This one, 1477 multiply by 130%. What is the new value coming? Tell me.
1920.
19.
1920, I think.
Now it's mean they are wanting that the previous value is this. Now the revised value would be 1920. And what is the balance?
Um, 4010.
Now see, this is the Kerrin, this is the Denton. You know, as we are solving the share for share offer, and in the share for share offer, this post acquisition value per share remains same for both of the parties. Do you remember, everyone? We have solved 4 questions on that. Now what will happen? See, the Kerrin company number of shares will remain same, but this Dentro company number of shares we do not know. How we will know that? 4010 divided by 750. What is the answer coming?
5.346. 346 or
This
47.
value will be same for both of the parties. Now, can you tell me what will be the figure here? What is the figure? 359. Now see, what was the problem in this question? Examiner did not provide you the share exchange ratio. Examiner can test you people in any of the ways. In the previous question, like we did Nanti company, we did Sigra company, we did Nahara company, whatever we did, in that question, the examiner had given you the share exchange ratio. In this question, the share exchange ratio was not given. So what was the problem? Examiner told you a hint. This was the hint that we want a 30% premium. The Denton company wants 30% premium on their existing value. This is the new value. The balance will be available for the acquirer. So you can compute this market value per share. And now, if you want to compute the share exchange ratio, guys, so this is due to our rounding of difference. This all come 360. 360 divided by 140. How much is coming? How much?
2.57.
2.57. So we can say almost 3. This is the share exchange ratio that acquirer is issuing its 3 shares for 1 share of the target company. Now, you have computed this value, this value, this value, and this value. Even there was no need to calculate the market value per share or this Kerrin company. Only you need this, and the synergies can be computed. Why I have computed this one also? Because if the examiner has specified in the question that you have to solve this question, you have to tell the examiner that the share exchange ratio. So you can easily tell the examiner that what can be the share exchange ratio. Clear? This was the share for share exchange. Now, let me know what is the percentage gain for Kerrin and the percentage gain for Dental. Tell me, Georgina. One is 4010 minus 3960 divided by 3960 multiplied by 100. And the same way you can compute for the Denton as well. How much? Tell me.
1.26. I don't know if I'm correct.
1.26.
That's what I'm getting.
1.26. And what about the second one? What is the second one? Hello,
30%.
30%?
Sorry,
Yes.
30%.
Okay, there's a misconception. See now, whether this price was given to you, the Denton company per share price was given to you in the question. See, this is 0.25. Okay. Okay, now see, we have computed the share for share offer. Share for share offer. So, see, what are our gains coming? What are our gains coming, guys? The same, the 1.26 and 30%. And what are the examiner gains? Almost same. The 1.26 mean 1.7 or 1.3, and this is almost 30%. Now see, the cash offer is still there. The cash offer is still there. Nothing to worry in that. In the cash offer, to solve the cash offer as compared to the examiner answer is quite easy. In the cash offer, just remember that the target company shareholders, they took off the cash and they leave the company. The pre-data will remain same. What was the post acquisition value? That was 5930. There's a one company, Karen, one company is the Dentro. Now the point is, only the Denton company is having the 750 shares. There is no shares available for the Dentro because for them now the offer value is valid. What is valid? Offer value. How much we are offering to them? What was the cash offer? Tell me. 13.1. So 13.1 and their number of shares were 140. What is this coming? 1834. What is the balance? That is available for the acquirer. Tell me what is the balance? 4096. Okay, and if you want to compute the per share, so that will be coming 5.45.
Okay.
Now see, again you can compute the percentage gain. 4096 minus original value 3960 divided by 3960 multiplied by 100. What is the gain coming? How much is the gain? 3.4%. And the percentage gain for the Denton company 1834 minus 1477 over 1477 multiplied by 100, 24%. Now see, One is 24%, one is 4.2%. Clear, everyone? Guys,
Excuse me, sir. Please take us to the calculation. Okay, thanks.
clear, everyone? Now see, examiner has asked you people, this was the share for share offer. This was the share for share offer, and this is that calculation in which we have gone through the share exchange ratio. In which examiner is saying 357 over 40. You know what is our ratio coming? What was our ratio? 360 over 140. So basically that working is all about this. This 1920 was the point in this question. If you will look at the examiner answer, if you will look at this 1920, if you will be looking at the examiner answer, that is a quite tricky. That is not understandable by you people. So that's why I have gone through this question. Now, the calculation part is okay. We have done so, but still the discussion part is very important. First of all, let's discuss the cash offer. In the cash offer, it is most that the Denton company is having 24%. This is having 4.2%. But just to say that upon the basis of the calculation, this company will do that, and that is not acceptable. See, this is the best part. The main advantage of the cash offer is that it provides Dental company shareholder with a certain and immediate return. The first point. Whenever one party, the target company, they receive the cash, so the first advantage they are getting the certain and immediate return. But however, the premium is lower compared to the share for share offer. See, in this 24, in this 30.9. And may be reduced even further if the realized gain gives rise to a tax liability. Like this is the gain. Upon this, you have to pay the capital gain tax as well. This is the best discussion the examiner has done so far. By indicating their preferred premium under both offer, it is possible that the shareholders have priced in the risk associated with an uncertain share for share offer, and on this basis may be indifferent between the two. Now try to understand what the examiner is trying to say. In this share for share offer, they have a concern here that the share for share offer only accepted if they have the 30% premium. Examiner is saying it is possible that the shareholders have priced in the risk associated with an uncertain share for share offer. Why it is uncertain? Because the 30% premium is being done. That was a condition attached, and under the share for share offer, what is happening? What is happening, guys? 3-for-1 offer is there. But this premium value, for example, in the share for share exchange, when some percentage is there, the company has acquired the percentage for the shareholding, the 51%. Later on, they are delaying the premium amount or they are reducing it just to say to have the company. First, they were agree on the terms. So this is a uncertain share for share offer. The cash offer may give rise to agency issue since Denton company founder no longer have a stake in the business even though Karen board is keen to ensure the founder remain in position after the acquisition. Now, again, there's an agency issue. What is that? Even they are taking the cash offer. This is an agency issue creating because the previous owner, they will be left the company. They are no more participant in the company. They cannot enjoy the group benefits. But still, what is happening? Even they are accepting the cash offer. The acquirer is giving them the insurance that the founder remain in position after the acquisition. But that is also a very diplomatic statement. The information provided is too limited to read too much into the intentions of the venture capitalist. You know what is happening in this Denton company? There is a venture capitalist. We have not been told that how this venture capitalist will. However, typically a venture capitalist, whenever you have to there is a venture capitalist has to free from the company, so there are exit routes. In the exit route, you have to give them their money back and they will left the company. But what is happening? So it's mean the venture, if the we see the venture capitalists, they will be preferring the cash offer because they are also the shareholders of the company. Now the cash offer transfers more of the added value to the Karen company without the need for dilution. Now this was discussed in the last class as well. This was discussed in the last, when the acquirer is giving the cash, so there will be no dilution of its shares, which may appeal to the shareholders as indicated in the question. Karen company existing reserves are sufficient to fund the cash offer, although this may be constrained future dividends or investment decisions. The best examiner has discussed. Now, if we talk about the share for share offer, first of all, try to understand for the acquirer point of view. In the if the acquirer is issuing shares, there will be dilution of the shares, which may not be appeal for the shareholders. But on the other part, if we are going for the share for share offer, we are reserving the cash for future investments or the future opportunities. For the target company, it is being seen that 30.9% is the shareholding. It is very appeal to them. They will be happy. And also, if they are going for share offer, they will be the participant of the group. They can participate in the group decision making as well. They are the participants in that new group, in the combined company. So a share for share offer would ensure the entire company shareholder interests are aligned with the Karen company shareholder, reducing agency cost, because now they are also the participant in the group. It also provides Denton shareholders the right to participate in the future growth of the larger company, which the cash offer would prevent. No basis have been provided for the synergy benefits. The increase in shareholder wealth is so marginal, even a minor deviation from the estimates could result in a reduction in the shareholder wealth from the owners of the Karen company. On this basis, it is quite likely they will not approve a share for share offer without further negotiation around the acquisition premium. What is happening? See, only they have the marginal. The acquirer is only having the marginal. If there is a slight difference, this from 1.7, it can be 0. So the Karen company, the acquirer is not ready to do for the share for share offer, because in the share for share offer, they are only having the minor percentage. They are only having the minor gains. As compared in the cash offer, the gains are 4.2%. These are slightly higher than this share for share offer. Okay, now for example, if you want to solve this question, the examiner has given to this question, and examiner is saying to you people, you have to assess in this question the skills. One is known as the analysis and evaluation. Other one is the skepticism. and the commercial acumen. What is the analysis? Nothing more. It is the application of the data given. Like which technique you have used in the combined market value. You will be telling the examiner that in the appendices 1, there are the computations for the combined market value, and on the basis of the computation, as the synergy is there, so we should go for acquiring the Denton company. That is the evaluation. When you are recommending that we should do this or not, only the 5 marks are being tested. So the 5 marks are allocated in between 3. So try to understand that only 1.5 or 2 marks are available for each. In the skepticism challenge, you will challenge the assumption used in this question. What are the assumptions? Like the synergy which has been calculated, the cost synergy was there, the revenue synergy was there. You can challenge upon which basis these synergy calculations have been performed. Then you can challenge in the way of the skepticism that as the Denton company is having the cash, the Kerrin company is having the cash available and the second company is having no cash. When both companies will be combined and there was a statement there that losses can be carried forward. If that losses will not be carried forward, then how these estimation of the synergies can be there? When we are going to acquire this company, if the data was not given to us, the real data, so all these estimates are fake, then what will happen? Then if there was any banker involved or any agent involved, the agent was biased, then all these synergy benefits will be wasted. Understanding everyone? What I am doing? Nothing. I am picking the points from the question. Skepticism. Question the assumption used, question the data used. It does not mean that everything is wrong in the question. And commercial acumen. Commercial acumen means the thing which you are going to do that is commercially sensible, whether there are any constraints, internal or external. Like in the commercial acumen, you can discuss that if this company is going for the cash offer, there may be agency issue created, because previously that business was a owner managed business, that was the owner of the company. Now when they have the cash offer, they have to leave the company. The agency issue can be created. They are not ready to do so because they were the owners. And further, if you have to buy the company, you are saying that you have to pay the 30% premium. This is the requirement in the question. This premium, as it has been stated, that you have the cash reserves. You have the cash reserves. But later on, if you are using all this cash, if you are using all this cash to acquire the company, to go for this premium, what will happen? How you are going to pay the future dividends or the invest in the future opportunities? Then you have to take the loan. If then you have to, the combined company have to take the loan, there will be higher interest cost. Maybe some covenants are attached to the company. This can be discussed in the commercial aspect. So hope now that this third question is making a sense towards you people. Clear everyone?
Yes.
Yes.
Okay.